Hey, Kimosabi here, giving a follow-up to the anatomy of a crash video that I made some weeks ago when postulating that potentially we are at a tipping point similar to 1929. I hope not, but everything seems to be gearing up for that. There's a nice setup that says that that is the potential here. Um, the current pattern is a double bump and run. Before we had quite a few bumps, but a double bump and run. Measuring the 2 week chart, current price action versus the 1 week chart back in the 1920s just suggests this is taking twice as long. So perhaps the decline also takes twice as long if we end up having something like that. Now, these are very large time frames, and the pattern doesn't necessarily have to play that way. Um, but there's a potential setup that says that it could. So just need to keep your head on a swivel and be aware that this is a potentiality. I wanted to zoom in on both of these charts since we've got price action now that is, well, we went further down since my last video, and it's looking very similar, eerily similar. Let's draw on this a little bit, just marking the 1929 or 1928 consolidation. No, that was 1929 consolidation and current price action consolidation in 2024. A lot of sideways there. Then you had the bump up, and it came and took out the liquidity below. Bump up. The first leg down came and took out that liquidity below. So there's your similarity currently. And what followed after was a lower high to a pretty substantial crash. That was the crash that kind of everybody refers to before having an extended rebound. So maybe we're having something like that go on here. It's either ready to go down now, or we're going to get a bounce up a little bit higher, take out those lows, some kind of ABC up or something like that into a lower high. If you see where previous price action or the anatomy of the previous crash that was kind of in the same pattern vicinity or whatever, you ended up testing the top of that consolidation. Right here, we kind of did the same thing already and rejected from it. Um, I think there's a gap up here though on the S&P 500 chart. There's also some liquidity up there, so we might come take that first. You do have a lot of bad sentiment going on in the markets, but sometimes that bad sentiment is just the start of things. So don't read too much into seeing people panicking too much, because that is how things tend to start. So watch the liquidity up there and a rejection from that liquidity. But so far, it's kind of acting the same. Came out and took out those lows, came up, took out those lows, bounced a little bit. This had already bounced a little bit, and it's already coming back down to retest those lows. We'll see if those lows hold. But from a liquidity standpoint, if I was to trade this on lower time frame, I would think if that wick gets taken out, since that liquidity was already taken, if you take out that wick, that suggests that the market is searching for lower liquidity, and there's your next liquidity on the Dow Jones at 31,000 area. So that would be indicative that it wants to go down there, and if it does, it could get pretty risky pretty fast. Let's just measure how much the decline was. Back in 1929, you had a 17.39% decline. I don't think there was too much panic on that decline, but probably similar to how it is now, where people kind of got shaken a little bit, but it wasn't the end of the world. Current price action, we're at almost 19% down, is what it's looking like. So very similar declines to take that liquidity and a bounce up. You had a bounce up. Now, I would expect this to bounce up a little more since this was taking twice as long, measuring the 2 week chart versus the 1 week chart. If this pattern is going to replay, I'd expect another 2 weeks of maybe up can come and take out the 42,000 area on the Dow Jones before further decline. You could see the type of action you had here on the 1 week chart. It was like a double top thing where price just would not progress further. So far, we just have a kind of a push up, and now we're retesting this entire wick, which that's kind of bullish. I mean, you have a nice buyback on this wick on the Dow Jones, so you're currently retracing 50%. So you should see some buyers step in, similar to the way you saw some buyers step in on that low, on the wick low. And what I always say is the stronger buyers are at the bottoms of the wick, the weaker buyers are at the middle or the top of the wick. So you might have some buyers stepping in here to push this thing up a little more to kind of double top in the 42,000 area before a further decline. But if this pattern does play, back in 1929, that was a 50% decline. And if we repeat that, 50%, man, that's 40%. Let's go down 50%. Get you down to 22,000 on the Dow, which is revisiting the COVID lows basically. So when price action went down to these lows, money printer started. That could be what the market is waiting on, and this is where you get the money printer. So the fear that I was having is this is where the money printer starts. That gives you a lackluster kind of uptrend into another lower high. I'm sure you could imagine that happening. If you study the history after this decline, there was bankers that stepped in and said we're going to prop up this market and start investing in it and buy stocks and commodities, and this is how much the price went up as whoever bought there was exiting here in profit, and it was not enough to prop up the market. So if we have a decline similar to that, revisiting the COVID area, taking all of that liquidity in short order, then you may have a similar type of retrace that kind of looks like that into maybe 2027 before a pronounced downtrend starts. So this could be money printer is going crazy and it's not doing anything. It's not propping up markets because money is going elsewhere. Money is going to foreign markets maybe, or gold. I mean, gold's been doing really well. Maybe we'll check out the gold chart. But I want to bring your attention to one more thing on the Dow Jones that I was just looking at earlier today, kind of on the larger time frame. Probably have to go with a monthly chart on this. So monthly chart here, and I'm going to start at the 1974 lows and measure up to the 2000 peak and project from the 2008 financial crisis. And you can see the price came to the 618, which is an area where you would expect a wave 5 to complete at the 618 of waves 1 plus 3 projected from 4 gives you a 618 target for wave 5. And I think there's divergence on this. Pretty sure I've been seeing that. I think I made a video about that before. So you have the 618 from 1974 to there. Now we'll zoom into the 2009 low, and we'll measure from that low to the end of this impulse and project from a potential. This is an expanding triangle wave 4 projected from the low, and lo and behold, we reach the 618 again. So that's waves 1 plus 3 projected from the bottom of 4 gives you the 618 target, wave 5. Now we will take the price action from the 2022 lows, or no, the COVID lows to the 2021 high, project from the 2022 lows. And again, that measurement gives you waves 1 plus 3 projected from the bottom of 4, a wave 5 target of the 618, and it hit it. So that's 3 times that this area right here is the 618 extension, giving you a wave 5 of wave 5 of wave 5. In my opinion, it's of wave 3. But after you reach wave 5 in this degree, your target should be somewhere in the wave 4 territory. That is, wave 4 retraces back to wave 4 of lesser degree. So you should see price revisiting the financial crisis 2008 lows somewhere between 13,000 and 7,000 on the Dow Jones. Quite often it reaches all the way down to the very, very, very low. Just trading Elliott wave over the years, I've noticed that is a pattern that repeats if that price action comes. So that might be the buying opportunity years from now, like 1920 or 2029, 2030 maybe, or if it comes sooner. But that would be an area of interest where I think most market participants would say the stock market is dead. Don't ever invest in it. It's done. It's never going back up, and that would just be coming back to previous support. Whether the money printer gets turned on like crazy in there, I don't know. We could also chop in here for the next 40 years as a wave 4, and that would just be a consolidation, a very large range to be played. So there could be some trading there over the years to come. Now, here's a chart of the Dow Jones Industrial Average divided by gold. It's funny that TradingView does not have gold as a currency to compare, so you have to type it in manually. But Dow Jones versus gold. I was watching Francis Hunt, the market sniper, and he was showing something very interesting with this, how since the inception of the Federal Reserve, you have increased volatility in real money terms versus the Dow Jones. So that's 1925 area. The inception of the Federal Reserve is right after this consolidation period. So they brought in volatility there. There's your crash of 1929, then volatility up versus gold. What can we see from this pattern? Well, most of the price action over the past 100 years has been inside this green box. You do have the midline being resistance there, resistance there, resistance there. It never really showed as support until 1990s, and then again in financial crisis time frame. And then money printer went crazy there. But the pattern kind of looks like this ABC is going to repeat here. So it would be two ABCs coming down, just matching this. Right there, and this one coming down here, potentially just coming back down to support. That would give you a target of 1.8 ounces of gold to buy a share of the Dow Jones Industrial Average. Totally seems plausible with those charts that I was just showing on the Dow Jones. If you do have a retrace back to wave 4 of lesser degree, those targets were 13,000 and 7,000, somewhere around there for the Dow Jones. Based upon the patterns, I see that as a realistic target. I think Francis Hunt of the market sniper is suggesting we go down to a half an ounce of gold per Dow Jones just to maintain the expanding volatility to the upside and the downside versus gold. So I'd say look for support at 1.8, but definitely a possibility to undercut that and go all the way down to a half an ounce of gold per Dow Jones. That would be crazy. I don't see this happening overnight. This is a long-term thing, and this would be, you know, in the years to come, maybe 5 years. But this is a 2 month chart. This is showing the past 100 years of history. To make it down there, you're talking 1930 or 2032, 2033, something like that. So gold and silver and the precious metals could be doing very well for the next foreseeable future. So what does that mean for our good old buddy Bitcoin? Hard to say. Is it a risk on our asset or a risk off asset? I think if you ask certain people, they'll tell you one thing and others will say something different. I think the buyers that have bought probably since the ETFs back last year, I think they believe it's a risk on or yeah, risk on asset. When when you got to go risk on, you buy Bitcoin, it's the fastest horse. But now that it's not going and gold is going, the ultimate risk off asset, Bitcoin is stagnating. So the people that think that um, Bitcoin is a safe haven, they're going to hold their Bitcoin even if it goes down. Those that want to just make money on Bitcoin, they're going to sell it. If it goes down, they're going to sell. They're going to sell. They're going to panic out. And then after that happens, then Bitcoin can be a safe haven asset because of the diamond hand holders that won't sell no matter what believe it is a safe haven, and eventually it will be because eventually there'll be a floor put down, and it won't go any lower. It'll be just um, too inexpensive, and yeah, price will just push up. Is it ready to do that now? Maybe. There is a potential here that you've completed. I think I showed this in my last video here. You have the wave one, two, 1, 2, 3, 4, 5, working on a wave four, and then comes a miraculous fear-driven fifth wave that could extend quite high. You'd expect it to probably equal the 1-to-1 of waves one plus three for a fear-driven fifth wave of that. So let's take a little measurement here from the lows, current high, and if this comes down to the wave 4 target of 67 I was proposing in the last video, if it comes down there, your 1-to-1 or extended will panic fifth wave get you almost to $500,000. Potential for the 618 here to be a target at 223,000. That's also a valid target. So that would be waves 1 plus 3 projected from the bottom of 4, giving you a target of 223,000. Still a respectable number. But if you really get panic buying happening, um, you could reach those higher numbers. What would incite the panic buying? Well, you probably think it's the bond market. The bond market has been, well, they've been selling it off and the yields have remained pretty high. So in that type of environment, the money printer doesn't come. But if the S&P 500 has a very sharp decline and you see gold and Bitcoin holding above the previous consolidation, but the S&P 500 or Dow Jones is down 30, 40, maybe 50%, the money printer is likely to come. There will be financial easing to try to ease that. If that happens while Bitcoin and gold remain strong, you're likely to see quite a dent or even the destruction of a lot of fiat currencies around the world. Maybe not the US dollar just yet, but uh, these are likely to accelerate to the upside, gold and Bitcoin. If it holds above there, then it's showing itself to be risk off and a safe haven. Um, in times of panic, it's holding strong. So, want to see it remain above 65,000, I think would be safe. I think the 50% retrace on a linear scale is 67,000, and that's where I would expect it to find support. If this is a 382 retrace, that would be wave A. You're working on a B wave. You might come down for a C and undercut those lows because it did double bottom there last week. 67 would be the area of a 0.5 fib retrace. It might be very sharp, similar to the way this leg came down here. So you had the ABC popped up and then sharp decline, ABC pop up, sharp decline into that 0.5 fib retrace, and then it'll start to just mosey on up. So those are kind of my macro thoughts of Bitcoin. I think you also have to look at the larger time frame here. If you're talking like a monthly, you do have a higher high. Where would your higher low be? It would be right in this vicinity at 34, 35. So if you do have some type of grid down scenario, or the internet goes down, trading goes down, stock market closes, maybe the exchanges close down, you're not able to trade anything, these might collapse and they just might liquidate everybody. And then when stuff gets turned back on, it goes up. What I would see out of that, that would be 1, 2, 3, 4, 5, and this would be ABC down to there. That's your wave 2, and this is just about to blast off. That would be, maintaining the trend. Higher high, higher low, higher high. There's your higher low at 30,000. It's something to be aware of. If price does get down there, you could see that as an opportunity. And anytime you trade Elliott wave, your wave 1 is valid. You have a valid wave 2 as long as it stays above the previous low, which will be 15,500. So you might get an excellent buying opportunity there. Not too confident it gets down that far, especially with this long consolidation here. You have a lot of reaccumulation. This appears to be a show of strength. This is just a back test, and you should resume just based upon the chart pattern, Wyckoff, Elliott wave, all that. You should be holding above that. If you're not holding above that, then something is definitely going way different, and you're looking down to 31,000, maybe as low as 22,000 on some real panic stuff, but it shouldn't remain down there too long. So not much price action happenings just yet. We haven't got a higher high close yet, but I think it'll happen in the next few days. We might have a higher high close here on the daily. Weekly, it's going to take all the way till the end of the week because we did not close a higher high. But I'll try to get a video out on Bitcoin trading price action either tonight or tomorrow. But yeah, those are my thoughts on the macro. Hope that was helpful to get insight into kind of what I'm thinking on the macro stage here. Be careful. Things are looking like they're about to get really weird in markets. So have a good night and keep them stops tight.